Hello and welcome to another installment of Insurance IQ, where we try to provide useful little helps and tidbits each week to make you a smarter insurance consumer. This week I had a great question come in from the audience. Someone was asking about the insurance coverage on your home, your dwelling coverage, and as it compares to and how it stands up to a really inflated building market that we are currently in. Lumber prices right now are down from an all-time high last May, but still remain 3 to 4 times higher now than they were prior to the pandemic. So that makes building homes, which are made out of framed wood, very expensive, and more expensive than they possibly were 2-3 years ago. So how do we come up with the figures that we base your insurance coverage off of? Obviously, the biggest part of your insurance cost is the coverage A as an apple, dwelling coverage that you'll see with the first line item on your home insurance policy. We use, in the carriers, they all use some form of reconstruction cost software. There's 3 or 4 major platforms, and a vast majority of carriers use one of these 3. We plug in all of the data, the cost of your countertops, and the type of your countertops, and the size of your house, and the average cost per square foot, and all these other data points that are averaged every single quarter and audited against total losses as well. So the software spits out a number based on the inputs that we give it with tax data and with the knowledge of the agent, and it spits out a figure that is an estimated rebuild cost of your home. Quick thing to keep in mind, it's the estimated cost to rebuild just your house. We don't insure your land. So there are differences between market value, which is what you actually pay for your home costs, and actual reconstruction cost of your house. The metaphor I always use is that if you take the same 2,000 square foot house from Lake Minnetonka, for example, and you take that off of the lakeside and you throw it in the middle of a farm field in Iowa, you're going to have vastly different market values because of the value of the land next to Lake Minnetonka. In theory, the house costs the same to build, whether it's in a farm field in Iowa or on next to Lake Minnetonka. It's not exactly, of course, but as you know, the market value would be vastly different between these two properties, but the average cost to reconstruct the house would be very similar, assuming all materials and things are the same. So we are not insuring you for your market value. We are insuring you for an estimate of what it actually costs to rebuild your house. So when we have these inflated costs in the market, how do you insulate yourself from these higher costs? So if you have a new insurance policy, or if you've quoted a new insurance policy in the last 3 to 5 years, each time you buy a new insurance policy, the agent is required to run this software. And they are required with the carrier to show that they've run the software and that the data is accurate. So if you've gotten a new home policy in the last 3 to 5 years, all of this software is updated regularly, quarterly in most cases, to reflect these higher costs. So if you've gotten a new house policy in the last 2-3 years, 3 to 5 years at most, I would argue that you're probably in pretty good shape as long as your agent did his or her job. The red flags I would look out for is that 10, 15, 20-year client of the same insurance carrier who maybe hasn't talked to his or her agent in 20 years and hasn't updated the policy in 10 to 15 years. These are the policies that sometimes don't keep pace with a historically inflated building market. You may be insured for $345,000 and it may cost $425,000 to rebuild your home in this current market. So the policies that have not been reviewed or checked or rewritten in the last 10 to 15 years are the ones that I would worry the most about. And those are likely the ones you see in the news where they have a total loss or they have a fire loss that they are unable to rebuild after because they didn't have adequate replacement cost coverage. So, a couple of things to keep in mind. Review your coverage every single year. It's going to have a built-in increase for it. It's going to go up 3 to 5 to 7% in the actual coverage line item to make sure we are accounting for some of these increased costs of construction. But nothing replaces the expert eye of an actual agent looking at it as if they're writing the new business policy for it and making sure that everything is accounted for, whether that's upgrades to your home, whether that's cost of construction, et cetera, et cetera. So review your home policies every single year and make sure. You can also buy endorsements, like similar to inflation guards, that provide a percentage above whatever you're paying for your coverage A. So for example, 125% extended replacement cost endorsement adds 25% on top of whatever you're paying for coverage A. So if you have a $400,000 home insured for $400,000 and you have a 125% extended replacement cost, you end up having an extra $100,000 to rebuild that house if it was necessary to rebuild. So a lot of these guards can be built in to make sure it's not an exact science coming up with that coverage A number, but it is an audited process that the carriers do a really good job and a really thorough job of trying to make sure are relatively accurate. So if your inputs are good and your agent has reviewed it, you should be in pretty good shape for this inflated market, because this software that all of these agents and all of these carriers are using are accounting for these increased costs. If you've been sitting on your home policy for 10 or 15 years, it's probably time to review it. So take a look with your agent, take a look with me. I'd be happy to look at it, make sure you're taken care of. So it's a good time to ask yourself, what is your insurance IQ regarding your rebuild cost on your home? Thank you very much.